Hey everyone, welcome back to Corporate Decoder, where we decode the confusing world of business one sec filing at a time. Today we're diving into SMX Security Matters Public Limited Company. And let me tell you, this filing definitely gives us a lot to talk about, especially when it comes to their financial maneuvering and rapid. Fire stock splits, it is like a corporate roller coaster. Before we jump in, if you love getting the inside scoop on companies straight from their regulatory filings, make sure you hit that subscribe button and ring the bell. Also, join our community Discord link down below to chat with us and other subscribers about these reports. Let's start at the very beginning of this prospectus filed on the 27th of February 2026, with the SEC SMX, or Security Matters, is an Irish company looking to offer up to about 30.4 million ordinary shares. They're essentially giving their existing shareholders a way to sell their shares, which includes shares the company might issue later under something called a Standby Equity Purchase Agreement, or SEPA. This is basically an equity line of credit where they can sell shares to an investor to raise funds up to $250 million. Right now, they've already tapped into this credit line, drawing about $11.3 million and issuing over 179,000 shares. This prospectus is for the rest of that funding. The company basically controls when and how much they sell, which is typical for these kinds of agreements. SMX sees itself as a brand protection and authentication company aiming to fight counterfeits and improve supply chain integrity. They're really leaning into sustainability and the circular economy, which is a pretty hot topic these days. They believe their technology can help industries use recycled materials more effectively and achieve net zero carbon emissions goals. Now, a big chunk of their story is a business combination that happened on the 7th of March 2023. This involved merging with entities like Security Matters Pty Ltd and Lionheart. It sounds like a pretty complex corporate restructuring involving schemes of arrangement and mergers. They've also gone through a series of reverse stock splits at a truly astonishing rate. Seriously, look at these reverse stock splits. They had one on the 21st of August 2023, then the 15th of July 2024, then the 15th of January 2025, the 16th of June 2025, the 7th of August 2025, the 23rd of October 2025, the 18th of November 2025, and the big one, the 17th of February 26, a 4.882812 to 1 split. It is like they're constantly trying to keep their stock price up to meet Nasdaq's listing requirements. Managing all these splits and their impact on the business must be a massive undertaking. Of course, all this comes with a hefty list of risks, and the report lays them out pretty clearly. They directly state in the risks that their financial statements for 2024 include a statement about substantial doubt regarding their ability to continue operating normally. That is definitely a red flag. They also mention significant accounts payable and other current liabilities and a history of not generating enough cash flow to meet obligations. This going concern warning is something investors always pay close attention to. They're also very open about the potential volatility of their stock price and the risk that a functioning market for their securities might not continue. It is good they're upfront, but it is also a significant risk for anyone considering investing. Let's look at how they're spending money. For the 6 months ending the 30th of June 2025, their general and administrative expenses jumped to $18.6 million, an increase of 157% from the previous year. This was mainly due to over $12 million in share-based compensation. That means a big chunk of their spending is on stock awards for employees and executives. Selling and marketing expenses also shot up over 333% to $1.38 million, again, largely due to share-based compensation and higher wages. Research and development expenses stayed relatively flat, though they decreased slightly. However, they noted that amortization increased significantly, reflecting the maturity of their assets. On the finance side, their income was $9.8 million, a massive jump from $1.6 million, driven by warrant revaluations and foreign exchange gains. But then their finance expenses also ballooned to $10.7 million, up from $3.2 million. This was due to warrant revaluations, loan interest, and share issuance costs. It seems like financial engineering is a big part of their operations. All of this led to a net loss of $24.6 million for the first half of 2025, compared to about $10.8 million in the same period in 2024. So losses are widening significantly. Looking at cash flow, their operating activities used $4.1 million in the first half of 2025, which is slightly better than the $4.5 million used in the same period of 2024. However, the increase in share-based compensation is a major factor here. Their financing activities provided $2.6 million compared to $4.6 million in the prior period. This decrease is mostly due to less money coming from warrant exercises and convertible note issuances. Their current outlook is pretty stark. They admit to incurring losses since inception and not generating significant revenue from technology sales. As of the 30th of June 2025, they had only $750,000 in cash and cash equivalents, but significant payables and liabilities over $22 million. They're heavily reliant on external funding and acknowledge substantial doubt about their ability to continue as a going concern. Digging into their business model, they target large brands and manufacturers aiming to set a new standard in the circular economy. They offer B2B sales and white label solutions with pricing potentially based on fees and volume. They're working with raw material producers to build trust and credibility. They highlight their innovative technology, a growing addressable market, and an experienced development team as key strengths. They also mention cross-segment activity and collaborative relationships with leading companies as crucial for their growth strategy. Their R&D efforts are focused on plastics, rubber, and other materials, specifically working on embedding molecular markers throughout entire production processes from raw material to recycling. They've had successful trials with recycled plastics and natural rubber, demonstrating their markers' durability and detectability all the way to the final product. Intellectually, they filed over 100 patents globally for their marking and reading technologies, highlighting a strong focus on protecting their innovations like their system and method for reading X-ray fluorescence marking. Looking at leadership, we have Offer Sternberg as chairman with extensive real estate and investment experience from Lionheart Capital. He is also involved with Burgerfi International and Cigarette Racing Team, which shows a diverse business background. Hagai Alon, the founder and CEO, is named on most of their patent families, demonstrating deep technical expertise. Zarin Brown is their executive vice president and chief strategy officer, bringing luxury brand management experience. Amir Bader brings agricultural business management experience to the board. Thomas Hawkins and Roger Meltzer have strong legal and executive backgrounds in Pebble Sia. Che brings legal expertise in mergers and acquisitions. And remember that shareholder rights agreement they adopted in February 2026 that is essentially a poison pill designed to deter hostile takeovers. It could make acquiring the company much more difficult without board approval. The report also mentions their struggle with NASDAQ listing requirements due to the low bid price of their shares, raising concerns about potential delisting and becoming subject to penny stock rules, which could severely impact liquidity. So what is the story here? SGX or SMX is a company with a bold vision in the sustainability and supply chain space, leveraging advanced technology and a significant patent portfolio. However, the financials paint a concerning picture. They are burning through cash rapidly with widening losses and a clear going concern warning. The numerous reverse stock splits suggest a struggle to maintain market price and NASDAQ compliance. While the technology itself sounds innovative, the path to profitability and sustainable operations remains highly uncertain. They're relying heavily on equity financing, and frankly, things look pretty precarious. Unless they can significantly ramp up revenue and cash generation or secure very substantial and stable funding, their future remains a major question mark. Alright, that is our decoder for SMX Security Matters Public Limited Company. What is your take on their constant stock splits and the significant financial risks they're facing? Let us know your thoughts in the comments below. If you found this deep dive valuable, give this video a big thumbs up and subscribe for more. And don't forget to join our Discord community linked in the description to keep the conversation going. Thanks for watching, and we'll see you in the next one.